All right, let's get right into it. We're going to break down a professional grade protocol for trading those high volatility central bank events. And let's be clear from the start, this has nothing to do with prediction. It's all about having a rigid, non-negotiable structure in place to navigate the chaos that always follows these announcements. This right here is the mantra. You have to burn this into your brain. Your job isn't to have an opinion on monetary policy. Nope. Your job is to execute a plan when volatility explodes and the market's own structure confirms the path of least resistance. That's it. No guesswork. So, the whole philosophy behind this is that we're not trying to guess the outcome of the event. We're simply following the information flow. Our goal is to sit back, observe how the market actually digests the news, see how that volatility moves from the most sensitive assets like currencies down into equities, and only then do we align our actions with that confirmed flow. Now, this protocol is built on a super strict hierarchy. It always begins with volatility, and that volatility has to be confirmed in what we call the lead assets, so foreign exchange and gold. If you don't see a clear, decisive reaction in those assets first, this protocol considers any trade in equities to be illegal, period. The information flow has stopped, and that means your activity stops too. Proper execution doesn't start when the news hits. It starts long before. This preparation phase is all about mapping the market structure objectively, without any bias. This is what allows you to react cleanly instead of trying to predict. So here's your non-negotiable checklist. Before the event, you have to have your key levels marked. We're talking the 15-minute bias, the VWAP, that's your volume-weighted average price, and of course the prior session's highs and lows. And that VWAP posture, it's absolutely critical. A rising VWAP suggests a continuation bias is in play, but a flat, compressed VWAP, that's a huge warning sign. It signals a lack of conviction, and you need to be extremely cautious. Okay, now we're entering the most critical phase. This is where most traders lose their capital, and it's almost always due to impatience and a lack of discipline. These rules of engagement are designed for one purpose and one purpose only, to preserve your capital during that initial chaotic repricing. Welcome to the kill zone. From 5 minutes before the release until 5 minutes after, your hands are completely off the keyboard. This is a strict no-fly, no-trade period. Your only job during these 10 minutes is to observe. Watch how liquidity and spreads are reacting across the different asset classes. The discipline here has to be absolute. That means no new entries, no adding to positions you might already have, and definitely no trying to fade that initial spike. You have to treat that first 5-minute candle as pure noise, because that's what it is. It's just algorithms, stop runs, and illiquid repricing. The real edge comes from letting all that noise settle down. So once that first 5-minute candle closes and the kill zone is officially over, we have to ask the first critical question. Was the move actually significant enough to even think about putting on a trade? And this isn't subjective, right? It's a quantitative filter. And here's that filter. The lead assets, your FX pairs or gold, they must break their pre-release micro range by at least 0.3 to 0.5%. If the move is smaller than that, it tells you the market is basically indifferent. The volatility hasn't qualified, and so equities remain completely illegal to trade. Now, there's another side to this coin. What if the move is actually too big? Well, that triggers a very specific warning, a red flag that we have to respect, no questions asked. If that first 5-minute candle moves more than 0.6%, we classify that as a probable liquidity sweep. It's an exhaustive move, and the protocol is crystal clear. You do not chase it. This is a condition that immediately invalidates any kind of continuation trade. Okay, so let's say volatility has qualified and we didn't get that massive liquidity sweep. Only then can we move to the execution phase. And here, a super precise, non-negotiable set of criteria must all align before any trade can be considered legal. And I mean every single one of these conditions has to be met. No exceptions. 1. The entry has to happen after the kill zone candle closes. 2. FX and gold must confirm the direction. 3. The equity index itself has to break its microstructure. 4. The relevant sector has to be aligned. And 5. The trade has to happen outside the prior day's value area, where most of yesterday's business was done. And there has to be enough volatility, which we confirm with the ATR filter. But even if all those checklist items are green, there are still only 2 legal patterns to trade. That's it. The first is the sweep and reclaim. This is a reversal pattern where an initial move fails and the price comes back and reclaims a key level. The second is the VWAP reclaim. This is a continuation pattern where the price pulls back to the VWAP, finds support, and then continues on with that initial impulse. Any other pattern you see is completely off limits. Once a legal entry is made, the focus immediately shifts to post-release management. This entire phase is governed by strict rules for your risk, your position size, and your timing. You know, time is a really critical factor here. The highest probability window for execution is that sweet spot between 5 and 20 minutes after the release. After 20 minutes, the initial impulse is probably over. A trade is only allowed at that point if the market goes quiet, consolidates, and forms a fresh, clean 5-minute range for you to trade from. Risk management has to be both aggressive and defensive. It's one trade per event, maximum. That's it. You're also cutting your standard position size in half, just to account for the crazy volatility. You set your initial stop, and you're moving that stop to break even as soon as the trade shows you a profit of 1.5 to 2 times your initial risk. Finally, before you even think about clicking a button, you run this last set of environmental checks. Think of these as the ultimate deal breakers. If any of these conditions are present, like if FX and gold are totally flat, or if the dollar index is moving completely opposite to what rate logic would suggest, the decision automatically defaults to no trade. This is your final safety net. And that brings us full circle, right back to the core mantra. This entire protocol is designed to do one thing: remove guesswork, opinion, and emotion from your trading. It forces you to wait for volatility to prove itself, for the cross-asset structure to confirm the move, and only then do you execute with unwavering discipline. That, right there, is the edge.